Hey, what's up, investors? Today I want to do something different. I want to take you through how I aim to build my portfolio, and I believe building a portfolio should take almost a lifetime, and it's not something you just do in a snapshot. So I will be taking you through my ideas about it, and I hope you learned something. But first, let me do a little housekeeping because it's been a while since you guys heard from me. And I thought I'd give you a quick update on what I plan to do with the channel and so on. So first, this week I did an interview with the Belegger. The Belegger actually is a Dutch word for the investor. Um, he interviewed me about DGOC. I think it was a very nice interview. It was he's a very nice guy, by the way. Very great guy to just hang out with and chill and talk to. So he interviewed me. He asked me pretty good questions. I think most of you who are here have already checked that out, and that is probably why you were here. So I'm also grateful to him. And I actually hope it's going to happen more often because it was very, very productive and very enjoyable to do something like that. Next, the plans for the channel on the website. If you guys don't know, I have a website as well. I will be linking it regularly in the comment or in the description of the video. And yeah, I just want to tell you briefly what I plan to do with the channel and the website. First, I would like to, in the short term, create an introduction video and to tell you a bit about why I'm doing this and what you can expect from the channel. And in that, I will include what I'll be doing. So, for example, I will be researching certain industries and sectors and give you a quick analysis on it. I will go more in depth for certain companies, like I did with DGOC. I also plan to do more research in the sense that I will be reading research papers, and if it is interesting, I will be sharing it with you and explaining what it actually means, what the research paper states, because in general they tend to be very, how do you say it, very tough to get through, really. Besides that, I would like to spend more time in sharing with you my thoughts on certain macroeconomic events and so on, because I feel like if you just go to your regular investing environment, you will hear people that are just stating that whatever is happening right now is impossible and it doesn't make any sense and it should go down or it should go up. And in general, things do make sense, but you cannot predict them, and there's a huge difference there. So I would like to share that with you as well. So I think that can be highly educational. Obviously, that will always be my viewpoint, so it's not like it's the absolute truth. There's always like pros and cons and right and wrongs, but yeah, in general, I think you will benefit from my solo brainstorm, which basically is what it is. I'm also working on a checklist for you to download. It will be available on my website. It is a checklist on moats, management, growth, fundamental analysis. It will be a version 1. I think it will include about 40 points of checklist for you to go through in order to make sure, well, not in order, but to make sure that you are investing in a company that you actually agree with or that you actually think that is a good company. Obviously, you can skip certain checkpoints and you don't have to follow them, but it'll give you an idea of what I'm looking at. So, yeah. And finally, I've been working on a few things right now. I haven't concluded them, so it may take a while. First one is travel services analysis. Like I know we've all been focusing on cruise lines, airlines, because hey, they're all undervalued because of the outbreak. But there's other companies that are related to it that are also undervalued, and it could very well be the case that you will have less risk there. So I want to share that with you. Second, I've been receiving a lot of questions about the gas price, obviously due to DGOC, and people are wondering what my thoughts are on gas and maybe the oil industry as well. So I would like to make a video about that and just share with you why I am not that worried about the lowest gas price in what, 20 years or maybe even like 30 years, and same for oil. And finally, I would like to make a video about the money printing in Europe and in America as well, because people are worried about it. They think we're going to have a high inflation, and in my opinion, I don't think that's the case. So I think those thoughts might help you a bit in staying relaxed and staying the course. But this was the housekeeping part, and I'm pretty sure you guys are very curious about how I would like to build my portfolio in the upcoming decades, I guess. So let me show you. So this is how I would like to allocate. I'm not going to say diversify because it's not the case right now, but this is how I would like to allocate my portfolio. So 60% is what I would call Assenderp's owned businesses. I will explain that in a bit. The 20% is deep value plays. And finally, both 10% is Assenderp's favorites and an allocation for the equity hedge. So I'm going to explain these 4 points to you, and then I will let you know how my current portfolio looks compared to my goal portfolio. But first I would like to talk a bit about diversifying, because as you can see here, I do not aim to diversify in the traditional ways, and I would like to share with you why that is. So, my thoughts on diversifying. If you just want to diversify and you want to follow the modern portfolio theory, and that you need to have at least 20%, 20 plus companies in your portfolio, under, like, with no exception, just at the start you want to have at least 20%, 20 plus, I keep saying percent, I don't know why, 20 plus companies in your portfolio, then I think in general you will do better with an ETF, because there will be no transaction costs overall. You will not be subjected to solo picks, your own picks. ETFs in general will be doing better for you if you just want to own at least 20 companies. If you want to build on your portfolio, which is an entirely different thing, in my opinion, then you can diversify it over a decade or over time and not within a few months. So what I mean by this is, okay, you just do your research, you keep doing your research daily, weekly, monthly, yearly, and you do your research a few hours a day, and you keep reading companies, you keep going through their financial statements, their risks, their 10Ks, you go on, you name it. You can just keep doing that, and you just slowly build your portfolio over time. In my opinion, that is way better, and I'll tell you why. Because absolute losses matter more. And what do I mean by this? If you have like €1,000 and you're gonna put it in an ETF, and the market has a drop of like 20-30%, what we've recently seen, then it's not gonna matter that much to you, right? It's like what, 200-300 euros. You probably make that back within a month of saving in your current job. But so you're not going to get used to certain absolute losses because you're not feeling it like that. So if you are going to build through time, or not through time in this case, you're going to just start with a diversified portfolio. You will never have these extreme drops instantly, and those extreme drops will cause for a higher absolute loss, and as you build your portfolio, your absolute losses are going to get higher. So if you start earlier on with higher absolute losses, you will get more used to that, and that will give you an emotional advantage. Because, like, imagine if you lose 10% of 5,000 euros. It's like 500 euros. That's not that big a deal in general. If you have 100,000 euros and you lose 10%, you lose 10,000 euros. if your job hasn't changed and you've just been saving for like 5, 6 years and you've built that portfolio, those 10,000 euros that you just lost are gonna make you feel pretty bad. And what I've been seeing recently in the forums that I'm on with mostly ETF or people who really prefer ETFs, and I think in general rightfully so, what has been happening is that they have been for decades, no, not decades, for years, so almost a full decade, they have been investing in ETFs. It has slowly been going up. They have seen small drops of like 5%, sometimes 10%, a little bit more maybe, but overall it has been going up quickly. Not quickly, sorry, steadily. And their portfolio has been building, but they have never gotten used to a absolute loss in a moment. So what I've been seeing is that people have been selling their ETFs because they were scared of the current situation, and it makes sense to get scared because everything, if you open the news, it's all negative. Everything is negative. It doesn't matter where you look, it's going to be negative. But if you are investing in ETFs, you shouldn't care about that. But they have never gotten used to absolute losses, and that is probably gonna hurt them over time because they haven't experienced the emotional pain that investing can cause. So what I suggest is that if you decide to invest in individual companies and you are slowly building your portfolio, money-wise, I mean, if you have like 100,000 euros, obviously you should instantly diversify. But if you have like between 1,000 and 10,000 euros, I think you should slide into diversification. I don't think you should just uh, select 20 companies for the sake of selecting 20 companies. You will not know enough about the companies to make a good decision. So keep that in mind, and that is also why I am so heavily invested right now in DGOC, because I haven't been investing for that long. So I think that I can manage that. So first one was Assenderp's owned businesses. I allocate about 60% into this, and you may be wondering what I mean with owned businesses, and that is basically truly owning a company. That is basically how I would see it is if I would create a startup or I would, let's say, buy a restaurant or something like that, you own the company. You are not looking to sell it at some point. You really just want to own that company. I think as any investor, you should really look at investing like that. You should think, okay, I can buy this company at an attractive price and it has a good growth rate, at least, let's say 2 checks for this time. And I am proud, or I am happy to hold this company for the rest of my life. I do not intend to sell it. And also, how is that company going to generate value for me if I cannot sell it? Because if you cannot sell a company, you are not speculating. You are owning a company. And I think many people want to look at it like this. They feel like, yeah, I'm doing this long term and I'm going to invest for the next 5, 10 years or maybe even longer, and I will hold this on for the rest of my life. I think that, yes, it's easier thing to say, but imagine not being able to sell a company. That's going to be rough on you. Imagine buying Netflix 100 times earnings and you can never sell it. That means that it needs to keep growing at an insane pace and it needs to be constantly evaluated at a high rating for you to retire and then sell it to a new CEO or a new business owner, because that's basically what you would do if you have your own restaurant. When you're going to retire, then you sell it when you really stop working. So that's how I would view it. That's the most important part about owned businesses. I also am very specific about owning a business. There is a very long checklist of things that it needs to adhere to. Like you have to, they are like bare minimums. Like I need to truly think management is great. I need to see multiple insider ownerships. I need to see very good cash flow policy. I need to know exactly what is going to happen with the cash. I need like openness from management. There's like a million things that I need. No, not a million because that would be impossible to follow up, but like a lot, like really a lot. It is, otherwise I'm not going to put like 10-20% of my portfolio in one company for the rest of my life. Like you need to, you need to be extremely confident about a company. And obviously you guys hear me say this and you know, well, the first video you made about DGOC, like, and you did that exact same thing, or you did exactly what you said just now. But I do not expect to find many companies like DGOC. So if you've joined my channel in the hope that I'm going to find 25% annual growth rate for the next 10 years consistently, I don't think that's going to happen. I think that's very unlikely to be so confident in that growth rate. Obviously it can happen, but in general I don't think it's going to happen. I think over the next 30 years I'll probably find 10 of these companies. It took me a very long time to find a company like this, and it took me a lot of convincing as well. Like in general you guys are not experiencing that because you just see, hey, he wrote that article and he started making videos about it. But like I think I got this company for the first time in July 2019 or something, and I invested in it and I left it to the side and I kept my eye on it. And as I thought like, hey, this is also interesting. Hey, I found this video about the CFO explaining stuff, and I got more into it and I started comparing it to like 30, 40, 50 other gas companies, and I was like, hey, they actually have a very compelling moat. And so you discover these kind of companies over time. You're not going to discover them in a week or a month. It's going to take at least half a year, I think. So keep that in mind. And what I just said as well, you must imagine never being able to sell it. Because if you do that, then you know that, and you still want to buy it, then you know that you are truly owning a company. Like I have to, for tax purposes, I have to say to the government, like, yes, this is my net worth, or like, you know what I mean? Like, you have to file the report. I mentioned this stuff, but in general, I wouldn't see it like that. I own this company. It doesn't have any money to me. It doesn't hold any money to me. It is a company that I own, and I do not intend to sell it for money. Keep in mind, it is the intention of not selling it. Doesn't mean that I'll never sell it. It's the intention that matters in this case. I've set up a few rules for now for myself. Like I want about 3 to 5 companies in this portfolio. I could go a little bit more depending on the situation, but in general, yeah, that is my aim. So you can see that it will be per company between 10 and 15%. But I think that in the next 10 years, I might find 3 companies that fit this description. So who knows how many companies I'll end up with in 10 years. They must be, that's the second one, they must be at least 5% of my portfolio, because if I have a lot of faith in a company, it should have an impact on my portfolio. So that is just a rule that I want to implement as well. And the third one, that it will be the last rule for now. I think I will create a lot more rules for this one over time. But the third rule is it cannot be a large cap company. And why is that? Well, I think with a large cap company, everything is basically priced in. There's too many people focusing on it. I do not think that you can find a business that you truly want to own for the long term. I think you're always looking to sell a company like that as well. Obviously, there are exceptions, and I'm pretty sure you can all name at least a company that you really want to own for the rest of your life, like Tesla or Microsoft, sure. But I want to be able to find them in the small and mid-cap sector because I know that there are not a lot of people looking there. So I think that is where the opportunities really are. So the deep value plays 20%. This is mostly just looking for undervalued companies. I think these companies will come and go most often. So what does that mean? It's like I buy them. When I buy them, I already have in my mind, or on paper, or in a YouTube video, or in a research paper, or a company report, I already have stated at what point I will sell it. In this 20% category, there is no amount of company limitations. I don't mind to have 20, 30, 40 deep value plays. It doesn't really matter to me, as long as they have a compelling upside and a low risk, obviously. And as I just said, they will come and go more often. I think that is something to keep in mind as well. And they do require regular attention. Like with the with the owned businesses, I would say that it requires a lot of attention at the start, and it will require a little more attention over time because you're more certain of your case. With deep value plays, I will need to look at it more often because when the story changes, so will my valuation thesis change. So could be the case, could be negative, could be positive, could be that, hey, this company is now turning into a growth company. Hey, my valuation needs to go way higher. So this is how I view it. Assenderp's favorites, 10%. This is basically just 10% of my portfolio in which I want to include companies that I love, or I love the products, I own or use the products. It's just something like that. So first companies that come to mind are like Netflix, Spotify, Disney, like mostly tech because I use a lot of tech. I'm also thinking about Microsoft because I love Microsoft Excel, for example. Google could be one as well. So there's a lot of things that are could be on this list, and I want to own them. Could be booking.com as well, for example, because I have booked regularly there for my holidays. So that is the companies that I want in this portfolio. The checklist. We'll get to that later. Let's start with this one. So I will not buy these companies at any cost. I still think that a fundamental analysis is required. Like if I think of Netflix, like I love Netflix. I think I have Netflix for like 5 years already, and yes, it doesn't bore me at all. I think it's a great concept, and I wouldn't want to let go of it. However, if you check the valuation right now, it is at the same close or at the same price of Disney, and look at what Disney has in comparison. All the parks, all the balance sheet is already more insane than Netflix. So it's not like, okay, I use this product, I love this product, let's buy it. No, it needs to be, in my opinion, undervalued based on the growth rate. So in what ways does it differ then from the other parts that I mentioned? Well, if I truly love the products and I use them and I own them, then I am more inclined to let go of certain parts of the checklist. So to give you an example, I would like to have in a company at least 5% insider ownership that is not the CEO. That would be a great sign for me because that means that even other people in the company think it's a great company at a great price and they want to have it, want to see it grow. That would be great. If those insiders are not there, or it's 1%, but I still think it's a great company, like that obviously matters. So I would be willing to let go of that part. So that's the way it differs from the other parts, or categories, I should say. So the final one would be the equity hedge. This is obviously for the future. I do not intend to hedge anytime soon, especially not under these circumstances because there has been some damage already and I'm still just building my portfolio. And once my portfolio is built, I think I should start to implement a hedge. And these 10 years until then, I'm basically just gonna research which one I'm gonna invest in. So the goal is to hedge against an all equity portfolio because as you just saw, like I'm only owning equities. And how I'm gonna hedge it, I'm not sure yet. Could be crypto, could be gold, silver, could be just commodities in general, could be future pricing, could be bonds, could be a combination. But I want to have a 10% hedge against it in the future. There's not much more to it, really. The benefit from it will be that it'll have allocation and I will make sure it's a fixed allocation so the 10% is going to be focused and I will be adjusting it accordingly when I buy stuff. So the 10% is fixed, but if the market fluctuates and let's say the gold price drops and now all of a sudden gold is 8%, then I will buy gold until it's 10% again, and I will do this yearly to keep it on 10%. And what this will do is that I'll make sure that I will buy either asset class, either equity or the hedge that I am deciding, I will buy that at a relatively lower price. And as I just stated, I don't know which one I'm going to buy yet. I'm going to research that for the upcoming years. I will make videos about it, articles, and I will include you in it. So the asset that I'll be using is currently undecided. Now for the final part, I am going to show you how my current portfolio is looking compared to this. And here you can see, obviously the owned businesses, I don't think it's a surprise like, oh my, what will the 62.3% be? Like, no, it's gonna be DGOC obviously, and the rest of it is all deep value plays. I think, yeah, it's still the case, none of them are up because of the crash, so all these deep value plays have become deeper. It's not a great sign, but yeah, it happens. It happens like once every 14 years. So yeah, a bit unlucky since I bought most of these in November, December last year. But it happens. Not much you can do about it. My favorite stocks will be mostly tech stocks, and those are still overvalued in my opinion. So we'll be sitting out on that. And yeah, the equity hedge is not there yet. So this is it basically. Just two parts. I would like to, before I conclude this video, I would like to emphasize that this does not mean that I'm not going to diversify. This does not mean that I'm not thinking about modern portfolio theory, that I'm not thinking about the risks that comes with owning a certain company. No, I'm very much aware of that, and I will take that into account, but I will take that into account over time and not in the moment where I'm just going to invest at the start and then think, okay, I need to diversify to avoid certain risks. No, I think, as I stated before, diversifying needs to be built over time, especially when you start out with a lower amount. And as it will continue, I will be more diversified. So if I show you my portfolio in 10 years, I have in mind that it will be like my gold portfolio, so it will be 60% owned businesses, 20% deep value plays, 10% favorites, and a 10% equity hedge. And in those categories or subjects, or however you want to call it, I will have a combined diversification to just hedge my all around portfolio against certain risks. So don't think I'm not going to diversify at all. You should always diversify. I just don't agree with everything we read about it, because what you read about it is basically for millions and billions of portfolios, and I am not managing that. I'm barely managing like a decent number. So yeah, you all gotta start small, right? So that's it. It's been a long video. I'm like 28 minutes in right now, so I hope I didn't bore you guys out. I hope you didn't fall asleep. If you didn't, please hit the like button and leave a comment below. Let me know your thoughts on on how I'm gonna build my portfolio. I would like to know how you guys are building your portfolio as well, because I think we can all learn from each other at this point. So make sure to let me know. Stay tuned for the videos that are coming. I do intend to be more regularly in uploading videos. So the stuff that I mentioned in the start of the video, like my thoughts and the sector analysis, I think those are coming within a week, at least 2 of those videos. So stay tuned for that one. And for now, I wish you all a great evening.